Hello and welcome again to the Cashflow Academy YouTube page. We're going to go through Dividend Kings, Dividend Aristocrats, Dividend Champions. What's the difference between them and why does it even matter? Before we get into that, make sure you hit that subscribe button so that you're notified when a new video comes out. We've got a lot of material, a lot of content that comes out to make you a smarter, more well-informed investor. So, dividends, what are they? Well, it's interesting. I had a discussion with my 11-year-old daughter yesterday at school. They asked, what does your dad do? And she said, well, he's a stalker guy. That didn't sound quite right, but I am a stalker guy. I do stuff with stock. So she said, how do you make money? And I explained to her that, well, when you think about products, like think about Apple iPhones, which we have. If you think Apple's going to sell more phones and make more money, that money, those earnings, some of that earnings gets distributed out to shareholders in the form of a dividend. And she said, oh, so every time someone makes a phone, we get a little bit of that money. And I said, well, it's not quite that simple. All of the earnings, all that the company makes are over time divvied out to the shareholders, and those dividends get paid out every 3 months or so. And she said, okay, well, I kind of get that. I didn't get into dividend kings and aristocrats and so forth, but the discussion could go further as, well, how do we know that a dividend is more secure? Well, a dividend king is a company that has increased dividends for 50 consecutive years. So that gives us a good understanding that, look, they've been doing this a very long time. They have a proven track record of success. Does that guarantee that they'll be able to do it for the next 50 years? No, it doesn't guarantee that, but it tells us that they have a economic moat. A moat means that, like your castle has water around it, it's very hard for others to intrude, to get access to the kingdom, right? And we look at a company like Coca-Cola, who's a dividend king. Why do they have an economic moat? Well, first of all, if you go into any gas station around the country, there's going to be a spot, a location for Coca-Cola products. So they're guaranteed to have shelf space. That is true of every supermarket, et cetera, because people know the brand and they continue to want to buy those products. I don't see that changing anytime soon. So, a company like Coca-Cola, if you believe that they have that moat, they're going to have some long term sustainability. And the Dividend Kings, they've been doing it for 50 years. Now, if we look at others, we might say, well, what's a dividend aristocrat? It's very similar, but these are companies that have done it for 25 years and they're inside of the S&P 500. They have a minimum of 3 billion market cap. They trade on average 5 million daily trading volume or more. So again, these are S&P 500 companies, but a 25-year track record. Now you're a dividend aristocrat. You'll notice that's very similar to the next one, which is Dividend Champions. They also have increased dividends for 25 years, but they're not inside of the S&P 500. These could be companies that are in the Russell 2000 or international stocks or what have you. These are companies with a long-term track record, but they don't have to be within that index. And so they've just given them a little bit different name. Now, when we look at dividends, we might say, well, do we want the company that's paying the highest dividend yield? Well, that gets to be a little bit dangerous. If you look at bonds, you don't go buy a bond because they pay the highest yield. The problem with that is those are called junk bonds. Those are companies that really could default and you could lose your capital. Yeah, they might pay bigger interest, but if they default, which they have a high probability of doing, you're going to be out that principal and you're going to have a losing investment. So there are junk bonds, there are junk dividends. A company that pays too high of a dividend yield is a bit of a warning sign that, hey, why is its yield so high? It's because the stock price is tanked. Why is the stock price tanked? Well, it's gone down so much because the company is in shambles, because the company has problems. Now, it is true that it's a risk and reward. If you could do your fundamental homework, find a high yield dividend, a company that you think is going to have a big turnaround story and a huge recovery, well, it would make for a very, very good investment. But that would be like Jesus bringing Lazarus from the dead. These are companies that don't have a high probability of success, that don't have a high probability of recovery. So when a dividend yield is at 15%, you know that that's just abnormally high. It's out of whack. It's not a normal percentage. A, they're probably going to cut the dividend. B, the company's share price might continue to fall as that business struggles. So a bit of a cautionary tell. When we're looking for yield in the dividends or the options or in a bond or whatever it is, we don't just look for what's the highest yield. We look for what's a good yield with good margins of safety, good economic moats, good things surrounding it, so that we know that the risk to reward is intact, it is solid, it is something that we can make money from over the long term. Hope you've enjoyed this video. Again, hit that subscribe button, make sure you hit the bell to be notified so that you get as much education out of these YouTube videos as possible. We're constantly putting out new content, so follow along, subscribe, and enjoy the process.